In this video, I'm going to share 5 reasons why the infinite banking concept will continue to grow in Canada. Hi, I'm Will Moran. So let's get right into it. The best tool for the infinite banking concept, IBC, is none other than using dividend-paying whole life insurance. Let's face it, whole life has gotten a bad rap, and I get it. I'm old enough to remember back in the day when buy term and invest the difference was all the rage back in the 1980s and 1990s. We were told to cash in that life insurance, terrible investment, that whole life. Buy cheaper term insurance and invest the difference in our mutual funds. Well, 35 years later, how's that working out? Well, for some people, it hasn't been that great. Maybe it was short-term thinking, not understanding the tax laws of our country. Now some of those people are retired and their term insurance has expired, and they're convincing themselves or trying to that they're okay with that. But I'm not so sure that their spouses are as okay with not having insurance as they are. And they're a little pissed about their mutual funds. For more than a decade now, I haven't really talked much about term insurance and mutual funds, but I do talk a lot about dividend-paying whole life insurance and adding term insurance as a rider to the policy. And if someone can only afford term and they can't get, they can't buy the whole life yet, we get the term to cover their needs because someday they will want to convert it to whole life and when they can save more. There's 5 reasons why infinite banking concept works best with whole life. First, it's whole life. That means that whenever you die, let's face it, we all will, your family gets the death benefit, tax-free. And the longer you live, the bigger the death benefit. It keeps growing every day. Second, you create the cash value. It's like you open up a bank account, except you own the bank. It's your bank, and you get competitive rates of return, plus it grows tax exempt. Number 3, it's creditor protected. You've got this iron curtain of protection because it's going to grow to a huge amount someday. Creditor protection is big, especially today. And by the way, they cannot freeze your account. Number 4, and this is another biggie, is you can use your policy as a personal banking system. Whenever you need cash, you simply go online, take a loan, and guess what? It still continues to grow as though you never touched it. This means that your cash value is always under your control and always in your possession. It's your bank, and it's always compounding tax exempt, even while you borrow against it. This strategy works entirely in your favor, as I'll explain in a second. Finally, number 5, when the time comes that you can turn your policy into an insured retirement plan, you can do that to generate tax-free income when the time comes. And if you don't make it through your retirement, many people don't, your family will receive more money than you likely could have accumulated on your own. That is exactly what the wealthy do. And this is how families create generational wealth to pass on to your heirs and not lose it to the capital gains taxes. Over the last decade, whole life insurance has become a mainstay in the Canadian market. It's just not your run-of-the-mill insurance anymore. It's had a total makeover and has become this powerful financial tool. And yes, you can be your own banker and grow your money even while you use that money. Whole life is built to do this. Nelson Nash championed this strategy that by running your dollars through a properly structured dividend-paying whole life policy, you can significantly improve your financial situation. Then what about the cost of borrowing? Here's the thing. Most people think that if you pay interest, 6% interest on a loan while your savings is only earning 4%, that the cost of borrowing will outweigh the benefits. But that's not the case at all. That 4% interest that you earn will end up being a higher number than the cost of the 6% that you paid for your loan. And the reason for this is that you're paying interest on a declining balance and earning interest on an increasing balance on your savings. In summary, here's 4 reasons for borrowing against your cash value and paying it back. Number one, the cash value stays in your bank and you control it. You control your finance, how you finance the things in your life that you'll need in your lifetime, rather. Number two, your cash value is always growing without any interruptions for the rest of your life. Yes. And number three, the cost of borrowing and paying your money back will work in your favor because it grows tax exempt. Number four, and here's the cherry on the top, when you retire, you need to supplement your retirement income, and you can leverage this money tax-free. It's called, as I said before, an insured retirement program, an IRP. And by the way, you can still leave more money to your heirs tax-free when you're done with it than you ever likely could have done on your own. So there you have it.